Markets are down, interest rates are rising, and dividend yields are up, making dividend stocks all the more attractive to investors. So what should you be looking for in a dividend stock? I want to highlight one metric that every investor needs to understand about any dividend stock they're looking at. Before we get there, I want to remind you to subscribe to Rive Investing. It really helps out the show. And thank our sponsor, The Motley Fool. The Motley Fool is offering their top 10 stock picks to buy right now. You can find those at fool.com/rive. That's fool.com/RIIV. Now, when it comes to dividends, what investors need to understand is the proportion of the money that they're making that a company is paying out in the dividend. That's simply just called the payout ratio. It's the total dollars in dividends paid divided by the company's net income. If you're paying out more than you're making in net income, that's not sustainable long term. So a company typically wants to have a payout ratio somewhere in the 50 to 70% range at the top end. A lot of companies are significantly lower than that, and I will cover a couple of those. So this gives you a couple of things to think about as an investor. One, it tells you if a dividend is sustainable. Again, over 100% is really bad news for the long-term sustainability of a dividend. But if a dividend payout ratio is very low, it tells you that the company has the opportunity to increase its dividend over time if it chooses to. So let's talk about a few examples of dividend stocks that I like. Not necessarily high yield payers right now, but companies that could increase their payments over time. I want to start with Verizon. This is one of my favorite dividend stocks today, and the reason is it pays a very high dividend yield, 6.6% as you can see right here. Now, there are a lot of questions about the company's business and how much it's going to grow long term. I will link to a video I did specifically about Verizon here, and you can get a little bit more information about my thoughts on the company and why I'm bullish on Verizon long term. But this is the dividend yield, and now you can see here, this is the payout ratio. So despite the fact that they have a very high dividend yield of 6.6%, still only paying out about half of earnings in the form of a dividend. That means that they can take almost half of the money that they're making from a net income perspective and reinvest it in the business, buy more spectrum, expand their operations, and grow cash flow long term. So this is a really nice balance. Investors get a really high dividend yield, but the company isn't taking on debt to pay its dividend, so it is a sustainable dividend. Now, what I would like to see Verizon do is take some of the cash that they're not paying in the form of a dividend and pay off some of the debt that they have. They've taken out tens of billions of dollars of debt in the last couple of years to expand spectrum. I think that was absolutely the right move. But now reduce risk and pay off some of that debt, and that will make the business more sustainable long term. The second company to look at is Apple. Now, this is one of the cash flow machines in the world today. They do pay a dividend, a relatively modest dividend of 0.6% is what they're yielding right now. But you can see they have a ton of cash flow, and that cash flow is growing. So what is the payout ratio at Apple? It's only about 15%. So remember I said 50 to 70% is a good target range to think about for a payout ratio. Well, Apple could increase its dividend by 4x and still be in that 50 to 70% range. That would put its dividend yield over 2%. Still not a very high dividend yield, but great for a company that's still growing and has as wide a moat as Apple has in the market. The final company to look at is a company that technically pays a dividend, but a very, very small dividend, but now has cash flow that I think it can increase that dividend over time, and that's MGM Resorts. I'm going to start here with the payout ratio. Payout ratio of just 0.32%. That's because when the pandemic hit, MGM cut their dividend to a penny, just to basically say that they continued to pay a dividend throughout the course of the pandemic and the recovery. Now, that was kind of gamesmanship. It's something that companies often do with their dividend. But you can see here that cash flow has actually returned to above pre-pandemic levels. In Las Vegas specifically, we're having record gambling revenue on the Las Vegas Strip. This is record all time. So not only has the region recovered from the pandemic, it's doing better than ever right now. That means that MGM could take some of the money that they're making and return to paying a dividend. You can see in 2020, early 2020, late 2019, the company's dividend yield was about 2%. Now, it could easily return to that kind of a payment and have a reasonably low payout ratio for investors. I think that's ultimately what MGM is going to do. There's simply not a lot of places to expand right now. They are going to be building a property in Japan but they don't need this much money to be doing that. They do have partners there and they can take on financing as well. Las Vegas Strip, there's not a lot of places that MGM can expand even if they wanted to. And Macau is a region where they have built the properties that they're going to build. If that region ever recovers, that should just be a cash flow machine, could help the dividend over time. So this is a company, very low dividend yield, also a very low payout ratio, but as their free cash flow has increased over the last year, I think this is going to be a dividend growth stock because of their ability to pay a higher dividend. So keep in mind when you're looking at dividend stocks, think about what is their payout ratio, what's sustainable, and is there the ability to increase the dividend payment even if earnings don't grow? That's something that I always look at. Let me know your thoughts on dividends, on this payout ratio. Is this a concept that you've thought about before? If not, there are resources out there to help find what the payout ratio is. I'm looking at Y charts right here, but there are others as well. Leave your comments below. Subscribe to Rive Investing. I really appreciate it, and I will see you here next time.